Today's economic data is just the start of a pretty packed week. Tomorrow, we get factory orders. Wednesday, ADP, international trade, and ISM services. Thursday, jobless claims, and Friday is the big monthly employment report. And the Federal Reserve will be paying close attention to that last one, along with a number of others this month. Steve Liesman tells us now what the central bank will be watching.
Whether the Fed hikes rates in September for the first time in more than 9 years depends on a series of critical economic reports to be issued beginning this week. Two keys to the rate hike: jobs and inflation, making the July payroll report coming this Friday an important one.
The biggest issue, of course, is employment. We need to see 2 solid months of employment improvement.
Economists expect one this week. The forecast is for 215,000 jobs and for the unemployment rate to remain at 5.3% for July, still the lowest level since the '08 recession.
If you look at how fast the unemployment rate has been moving over the last 2 years, it's moving more rapidly than at any point when they got to the first tightening other than the early 80s over the last 40, 50 years.
The Fed at its last meeting called the job market solid and said it only needed to see some further improvement in order to hike rates. So even a moderately strong August employment report could seal the deal. But the inflation data also have to cooperate and move back to the Fed's target.
I think that's where the real debate's going to be. Are they really confident inflation's going to make it back up to 2%? I think if it remains steady, that will be enough to nudge the Fed.
What could stop the Fed? Many economists point to overseas weakness and concern there could be a bigger impact from the Chinese market meltdown that could affect the U.S. economy. They could combine to stay the hand of the Fed in September. For Nightly Business Report, I'm Steve Liesman.